In my 20s, I made a few investing mistakes that cost me way more than I realized at the time. And looking back at it now, these mistakes have probably cost me thousands of dollars. And so in today's video, I'm going to share those 5 mistakes so that you don't make them yourself when you start investing in your 20s. Let's go ahead and get into the first mistake that's cost me thousands of dollars, and that is holding too much cash. I've always been a fan of holding quite a bit of cash. Most people recommend about a 3 to 6 month emergency fund, but I actually prefer a 6-month emergency fund minimum. If you have dependents or you have a job with a shaky, salary, I actually recommend pretty much going all the way out to 12 months. But even that said, over the last few years, we have held over 12 months of cash consistently. And some of this is due to money we've saved for a down payment on a house, which if you have something like that coming up, I think you should definitely save that in cash. If you need it within 3 years, don't invest it into the market because you never know what the market is going to do just over a year or two. But that said, outside of saving for big events like that, I really don't think you need any more than 12 months cash in a savings account. This is something that I made the mistake of, and looking back at it, I know it's being conservative, but with how the market has performed over the last 3 to 5 years, I've missed out on thousands of dollars in compounding and appreciation if I would have had that money invested. Now, would I be saying the same thing if the market had gone down over the last few years? It's hard to say, but giving my financial situation or my wife and I's financial situation where it's just us, we both have pretty consistent jobs and we don't currently have any kids, we likely have a higher risk tolerance than compared to most people and could have afforded to invested more of our cash savings over the last few years versus keeping so much of it in cash. But that's hindsight 2020. That's one of the lessons I've learned. If I could go back, that is something I would change. The second thing that has easily cost me over 4 figures is overtrading and doing too much. When I first started investing around 19 to 20 and kind of into the start of college, I really got into day trading, really got into doing some day trading options with a friend of mine, and it was a blast. We had fun. But holy cow, it would have been way better just to invest that money in a simple index long term. I would have made more doing that than I did, on any options. I think probably if you look at the overall profit and loss from that time, I probably didn't make any money for a couple years there. And so I really lost out on some important appreciation. If you want to try one of these risky strategies, day trading or penny stocks or something like that, I will tell you now, don't do it. But if you just say you want to try it, doing it early in your 20s is the time to do it with a smaller portfolio. Your mistakes are going to be cheaper. Your lessons learned are going to be cheaper. I'm glad I did it in my 20s. It can only cost me, a couple $1,000s versus if I would have tried it in my 40s with a massive portfolio, it probably would have cost me tens of thousands of dollars. And on the same topic of overtrading is actually overthinking. These kind of go hand in hand, but even if you move into long-term investing, you do not want to overthink it. You want to consistently buy in the market day to day. You need to ignore the noise. This is a picture that a friend actually got me of the S&P 500 from 1928 to 2022. And I'll probably just throw a picture of it up right here to make it easier for you guys. But what it does is just show all of these historical markets that most people thought were probably going to crush the market and cause it to do all kind of crazy things long term. It talks about the recession 1937 to 1938. It talks about Black Monday in 1987. It talks about the dot-com bubble. It talks about the 2020 stock market crash when the S&P fell 34%. And despite all those events, the market has consistently gone up and to the right. And so to wrap up number 2, overtrading and overthinking, they kind of go hand in hand. Keep your strategy simple. Make it to where you don't have to think about it too much, and you are going to see the best returns from your investments doing it that way. Number 3 is one that a lot of people learn early on, and you might have already learned this lesson even with just a short time of investing, but that is chasing hot stocks. Every few months there is a new hot stock that is in the news. It's on CNBC. People are posting about it on X, but it never fails that what goes up extremely fast a lot of times comes down just as fast. If you go back and look at some of the COVID stocks, Zoom, Peloton, these were huge names when the pandemic was happening. But if you go look at those charts today, they have been absolutely crushed. And there are so many people who bought these stocks at the top and who are still down on their investments and would have been much better off just buying the S&P 500 and holding it long term. Ask me how I know. I personally bought Square or Block during the same period. I actually just sold it off a few months ago, but I held it in my account for a few years and it was down, I think, around 90 something percent from where I had bought it. And so that is a tough lesson that I learned. When it goes up fast, likely will come down just as fast. And so just kind of keep, a bigger picture with some of these names start to get hyped up. They can be dangerous if you get into them at the top and things are overpriced. One platform that I'll actually like to use to kind of judge how people are viewing a stock and whether it's, maybe overhyped or maybe it's just being trashed too much is X. I'll link a free PDF down below. I'll put about 20 of my favorite accounts on there that you can go and follow if you want. I've been on X for probably 7 or 8 years on the investing side of things. It's one of my main platforms for financial news and kind of to keep up with what the market is doing. So if you want to get that, I'll make it free. It'll be down below in the description if you want to check that out. The fourth investing mistake that I know has cost me thousands of dollars is ignoring fees. I made a full video on this as well, and it's on the channel right now if you want to go check it out after this. But ignoring fees that are seemingly small can make a difference of hundreds of thousands of dollars over the long run. I'll put the example up right here of the Vanguard example that shows the difference in fees just to kind of give you an idea of what it can cost you. But whether you're buying an ETF, whether you're buying a mutual fund, whether you are using a financial advisor or something like that, you need to understand the fee structure that you are paying. Actively managed funds will have a higher expense ratio than passively managed funds. So this is a reason that I like S&P 500 ETFs, for example, because typically those have a very low expense ratio. Vanguard's average expense ratio is like 0.03%. But if you go into actively managed funds, that'll go up. If you're using some type of investment advisor, make sure you just ask them what their fee structure is. Ask them to send you the funds that you're invested into and see the expense ratio that you are paying on those funds. I did this with a friend of mine about a year ago, and we actually found out that this financial advisor that he had him invested into a mutual fund that was about 90% similar to the S&P 500, but he was paying an expense ratio of almost 1% on that fund. And so he basically sold that off and just bought an S&P 500 index, and just that simple little move is going to give him basically identical returns, but is going to save him thousands of dollars over the long run because he's not going to have that fee eaten away at his return every year. And so to make sure not to ignore the fees, I did it when I first started, 0.2%, 0.5%, who cares? That's not that much money, but as you continue investing, especially when you get a larger account, those fees are going to add up. They're going to impact your returns. So know the fee structure that you're paying for, and it is going to save you thousands. Number 5, and this is kind of an obvious one, but that is just not starting earlier. I did start early in my 20s. I started around 19, but like I mentioned before, I kind of went through options. I went through day trading and penny stocks, and I wasted a handful of years right there, not just investing long-term in the market, but even though that was a good start, I really wish I would have started sooner. Back in high school when I was doing summer jobs, I wish I would have had a Roth IRA opened up back then. I wish I would have got my brokerage account set up and just started investing a small amount, because the most important thing with investing is learning the consistency that it takes and making all your mistakes early on. Like I mentioned, starting early is great because you learn how to invest, you learn what not to do when you're investing, and then on top of that is just the also compounding potential of your dollar. I'll throw the chart up right here of what $1 can turn into invested at different ages. But as you can see, I mean, even just from like 19 to 25, there's a big jump there. And so it is super important to get started investing. If you're in your 20s, you're getting a great jump on it already. But man, if you can really start on those early years, you will give yourself a huge potential long term to let that money grow and compound in the market. And so if you're in your 20s, I hope you can learn from my mistakes and save a few $1,000s or make yourself a few more $1,000. If you have any other tips that you would recommend, drop them in the comments down below to help another fellow investor out. Like I mentioned before, hit the subscribe button as well. I'm a new channel and would greatly appreciate it. But thank you for watching, and I'll see you in the next video.